That's awesome. Yeah. So episode 2. Oh yeah. So here we are, back with. We don't have a name for this podcast yet.
You gotta come up with one, man.
God damn it.
We're working on it.
It's outside my scope. I can't help you there.
Anyways, welcome back. Our first guest in our podcast is our very own Brent Daviault. He is a chartered investment manager at RBC Wealth Management. And just chatting, he's a great friend, client, and just chatting with him a couple of days ago, casually, I told him, we're doing a podcast, and then it just clicked, right? I'm like, RBC's trying to buy HSBC, and there's so many things going on with interest rates, etc. I thought it'd be the perfect guest for the podcast. So here he is.
Thank you for having me.
Awesome.
Good to be here.
Thank you for coming, Brent. And we were just chatting casually earlier today, and just talking about several different things. One that came up just now, Brent purchased a property a few years ago, and we're talking about fixing rates, variable rates, etc. And I was telling him, he brought up the trigger rates, and actually I have like my own personal experience with trigger rates. For those that don't know what a trigger rate is, I mean, it's pretty much at the point where you have a variable rate with fixed payments. However, gets to a certain point where your payment is not even covering the interest. So you have to either increase your payment or, push the amortization, but certain points you can't even do that anymore, right?
Yeah. Or make lump sums. Either way, you got to find cash somewhere.
You got to find
It's not good.
It's not good. So,
No.
So it happened to me with one of our mortgages, and we were just chatting about that. It's it's a tough pill to swallow, locking it in back in 2021
So I was 2021, closed in April 2021, and I locked in at 155, and we were kind of laughing. The mortgage agent was wondering if I wanted to go variable. We were kind of saying, it's how much lower can we go? It's you're giving away money. So I got 155 at 5 years, and I don't really want to think about renewing that in 5 years yet. So I'm enjoying it, but it was a good time to borrow. Made things more expensive, but good time to borrow.
Yeah, my heart dropped when he told me that because we bought this property where I had the trigger rate around the same time. Pretty much. I actually closed in April too. At the exact same time. And back then we were being told, like, it might increase, 4 times, 5 times. And, in our heads, it'd be like 25 basis points, right? Not 75, 1.
Or 100, yeah.
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 Not 175. And I think we started that mortgage at 1.37, and it's free money, right? Like, I mean, based on inflation, it's literally like they're paying you to have a mortgage.
Yeah.
But fast forward now, I'm at the rate is 4.99, right? That's before any other increases.
Yeah.
And so for me to bring the payment in line, it goes from, and this is a tough pill to swallow, it goes from $2,400 a month to $3,900 per month at the current rate. So definitely a tough pill to swallow, but Brent can talk a little bit about the forecast. RBC uses obviously these are all predictions. This is all forecast. Nothing here is to be construed as advice. But there is a few indicators, right? And obviously Brent can talk a little bit about them coming out of the U.S., that can tell us a little bit of what to expect here in Canada, because we're so tied to the U.S., right?
Yeah, the economic slowdown that's happened, the recession indicators, one of the big ones is the inversion of the yield curve, which basically means that you're getting more return on your money in the short term than you are in the long term. And that's kind of an odd happening right now, because the longer that you borrow money, and for us as a GIC, you are in essence the lender, you take on more risk the longer that the duration of that investment is. So for it to be a lower return, and a 1 year pays 5.15% and a 5 year pays just under 5% right now. So for that to be lower, it's better for you to be short term. That kind of tells you where the economy's going and where they think interest rates may go. And again, these are just forecasts based on the data that we have right now. But we've seen a huge spike in interest rates for home purchases. So as you just mentioned, yours just kind of increased very rapidly, and everyone's feeling that pinch right now. And so we don't think the rates are going to drop as fast, but something has to happen with monetary policy to take that pinch off of people's wallets, to take essentially what they wanted to do and why this happened was to kind of curb inflation a little bit. And they've done that. They've kind of brought that back to normal standards. Or not normal, but they've slowed it down from going up. And so now they need to take the pinch off people's wallets from a borrowing perspective. And so the forecast that you had seen is they think that there may be one more rate hike, and it might be a small one. And again, this isn't guaranteed. This is just kind of the forecast. But from there, we think that the rates are going to kind of flatten where they are. They may kind of stay sideways for a little bit. They may stay kind of where they are, up and down a little bit. And then over time, they want to get that back to a normal baseline rate, the borrowing rate of about 2 or 3%, which would get that in line with inflation. So that's a major indicator right now, and it's going to be a slow burn, we think. The rate increases that happened occurred very fast, but we think that come back to reality is going to happen, and the government needs to kind of help out their people again to kind of back on track. So
that's great, and that's some amazing insight, honestly, because it's one of those intrinsic, like how can I say it, like these forecasts and this information, it's extremely valuable, right? Because getting it from someone like Brent, it's different than getting it from the headlines, right? Like the headlines are headlines, and sometimes you got to dive a little bit deeper, and that's what I tell all our clients, our friends, whenever you see a headline, make sure you read the full article. Don't just don't regurgitate the headline.
Do your fact check.
Like read the full article. Read it thoroughly and make sure it's accurate, right, before spreading that news. I found myself actually reading an article, same thing with the rates and everything, where the headline actually like part of the actual body of the article contradicted the headline in some points, right? So it's super important to do your fact checking and obviously getting it from a reliable source. And
it's kind of helps with the planning as well. So you had mentioned that I have a 155 rate, which is fantastic. You joke with our parents' generation, and they were looking at 20% rates in the 80s, and I don't expect to come and renew my mortgage at 155. Our generation has been very lucky with the borrowing rates, and we've had, since the mid 2000s, late 2000s till now, rates have only decreased. That's kind of the environment we've only seen. We've only seen money get cheaper to borrow and cheaper and cheaper. And it's not just housing, it's lines of credit, it's loans, it's everything. And so this is the first time that we're seeing it go the other way, and it couldn't have happened faster. And it's crazy to see what that's doing to, again, the incomes and the overall financial position of people. And it's I don't want to say it's scary or concerning, but it's definitely, if you're not taking a look at what the numbers and the rates and things like that are doing and changing and the impact it's having, you're doing yourself a disservice, because you do need to see where that's impacting yourself across the board. And it's 100%. It's a big impact. It's huge. Like you say, your mortgage payment went up 50%.
50, yeah. Like
more than 50%.
More than 50%. Like it pretty much, the rate tripled, and the payment itself went up.
And we hate those stress tests, and it might push you out of a house you want because you can't qualify, but this is exactly why the stress test is there. And they say, do
you think, and that's a question, actually, it's a good question that you got, it's good that you bring it up, because it's a question I had. Do you think the stress tests are as high as they should be? Do you think they helped? I mean, I that was my argument. I thought, like, if it wasn't for the stress test, like a lot of people would be in a really, really bad spot right now.
The stress test first off, I actually don't know who makes the rule, but there's a minimum baseline. I don't know if it's CRA, the Government of Canada, or CMHC, whoever does it. They have a minimum baseline, and I can't remember exactly what it is. It's, whatever your deal is +2 or prime plus a certain amount or something. And that's the minimum. Some institutions, some lenders will go above and beyond that because they're mitigating their own risk. So the stress test, I think, while annoying, is there for a reason. We don't like speed limits sometimes, but we have to follow them. They're there for a reason. And it's to protect you without knowing it. And so this is I think it's a necessary, I don't even want to call it an evil, but it's a necessary guidance that's
Yeah.
needed for people who don't necessarily know the full repercussions of what these moves can do.
Yep.
A $500,000 mortgage that goes up from 2% to 3%, that's a $10,000 mortgage payment or interest a year to $25,000. That's $15,000 more of interest, and that's a $500,000. That's a small mortgage these days. You're seeing houses go much higher than that.
The average price is hovering around 700. I mean, it almost broke 800 last year.
Exactly.
At the beginning of this year.
So again, and we deal with lots of clients, and particularly very affluent clients who, we can find $15,000 to do that, but not everybody's in that position. It's young families and things like that. So what are you going to change? You're going to change your lifestyle. You're going to take, less gas for your car. Are you going to take a kid out of a camp or out of something to find that money to make that payment? So if you haven't planned for that and budgeted for that and considered that, and it is sad to consider these things. You don't ever want to have to consider those things. But the last thing you'd want to do to pay debt is take on more debt. So it's, I think the stress test, going back to your question, is very important. It's very relative. And, it kind of takes the shine off of the home buying experience when you're told you don't qualify because of a stress test. But at the end of the day, is it more annoying to have been told no, or to be told you can't afford your mortgage anymore, give your keys up?
Yeah,
And
exactly.
I do think it's a good.
I think it's softening the blow a little bit right now.
Yeah.
The stress test. Has it always been around the stress test, or is it a new? Is it like the last 5 years? Do you know if it's been around for longer?
I don't remember. It hasn't really been relevant because the rates have been so low that it's been a moot point. But I think there used to be some kind of qualifying. They might have made the stress test harder.
Okay.
They might have made the qualifying with that more difficult. It's funny. I used to do mortgages before my job now, and I feel like I should know this, but I can't remember. So.
Well, that's it. You're fully focused on your job now.
That's
so
it.
good.
Yeah.
So that's awesome.
But it's there's a lot of things that are surrounding it, and kind of feeding off the stress test is you seeing again conditions of financing and things like that.
Yeah.
I can't imagine how much fun it was as a realtor in 2020, 2021 when things you didn't even have to. Not that you didn't work hard. I'm not saying that, but it was certainly an easier time.
Yeah.
But you're seeing it now, and
Definitely.
this is kind of
definitely right. Like it was.
And you did work very hard for me.
Thank you.
So
thank you.
Put that on the record on the mic.
Did you take that? Did you get that?
Yeah.
Okay, please make sure.
And continue to do so.
There you go. Put that on camera, please. Big bold letters.
Yeah.
Captions, big bold letters.
Yeah.
Yeah. No, I think it's it's right. It's true. Like it was a lot more fast paced, right? It had its challenges, like in the sense where it was a little bit harder to advise, right? It's so fast paced, like you want to protect your clients, but at the same time, like they need to, go all in to be able to get a property sometimes, right? So it was like that fine balance between like, hey, I don't want you to overpay, but I really want you to get that property. Yeah. So it was really hard in that sense. Now it's just a different set of challenges. I would say now it's a little bit easier in a lot of ways. As long as you have the clientele, as long as you have the leads, the buyers and the sellers, it's actually a little bit easier on a few ends right now because there's more time. Yeah. There's more time to do the due diligence. Buyers are taking their time. You're able to protect them even more. Yeah. Right. So yeah, it's got its pros and cons for sure. But yeah, no, most offers didn't have any conditions, right? There's no financing conditions, etc. And right now it's super risky going without conditions, right? Everyone, like, even based on the forecast we were talking about right now, like most banks are tightening their lending, right? So so that's a little bit tricky, but
and they're there to protect you, the consumer. That's the conditions you put in, condition of financing, condition on being able to sell your home, things like that. That's exactly so you don't get caught in a pickle where you have to try and find something or do something different. It's just to make sure that all your ducks fall in a row as they should when it comes down to the close of either a buy or a sell, whatever it may be. Yeah. So
it's funny that you bring that up, and I'm so happy you brought that up because I didn't have it in my notes. It's a story, right? And it's a story that we have. It's very recent. We had our clients. They came to us as a referral from a friend of theirs because they were in a bit of a pickle. they had an agent that sold them a property without any conditions whatsoever. And this was like 3 months ago.
Yeah.
Already the market was a little bit, softer. You were seeing conditions, so there was no excuse not to, right? And with a quick closing on top of it. So closing in less than 30 days.
Yeah.
No conditions. And they needed to sell their house to be able to buy this other house. So it put them in a really, really hard
So
position.
they had to have a quick sell on their own.
Yeah, exactly. So they had to, on their own home. So they had to bridge finance.
Yeah.
And obviously at exorbitant rates.
Oh, that's never cheap. Yeah, it's usually right now at double digits easily.
Yeah. So I'm not privy of the actual interest rate, but yeah, probably like it would, quick close, etc.
It's short term, but it's steep.
You can only imagine, right? So that the amount of stress that they had to go through,
Yeah.
because of exactly this, lack of due diligence. So it's super important. Yes, we take pride on that. Jen was talking about that earlier, and she was sitting where you are right now, and she was just talking about quality and doing things right, and yeah, it's super important.
Yeah.
It can really change someone's life, right? Like.
And we are such a, kind of going back to the generational thing, we're such a generation of now. We want it now. You want to be in your dream home now.
Yeah.
And it's you want to get in that house now. And I was guilty of that even when I bought my place. It's like there wasn't a bed in there, but it's like I want to sleep in it now. It's mine. I want to have it. It's like, you know what? It's the classic buy pizza, sleep on the floor, and make it happen because it's yours. But jokes aside, it's everyone wants, and everything's so accessible. Amazon delivers to your house today. You can get Uber Eats. I Ubered here. Everything is so accessible, and I think that transitions kind of from an emotional tie to home purchases as well. Like you want that. You sometimes put these blinders on that you just want to get the deal done at any cost because you see something that's shiny and bright and you want it. And again, that's where I think a good agent comes in.
Yeah.
Who will take you by the hand and say, hey, wait, this is awesome. Yeah, fantastic property. We want to get this for you, but let's do it right and let's protect you.
That's it.
And there's value in that. And
it goes both ways too, like in wealth management too, right? Like,
exactly.
We've seen what happened with FTX, and that's a different conversation altogether.
Exactly.
The crypto world, right? But
I
guess it kind of goes hand in hand. Right?
There's a responsibility to your client that we're the experts, and having the right person is definitely, again, I would say in real estate and wealth management, whatever it may be, is huge. And having a good relationship, being comfortable sharing details about yourself and what you're looking for, and having these candid conversations. And I was lucky that I was a third generation Daviault to go through you.
Yeah.
So there was already kind of an intimate relationship with the family and knowing each other and having confidence and trust and faith. And so again, going back to the conditions and things like that, you knew us, we knew you, and you kind of took me by the hand and showed me the way and how we get the deal done. And thankfully my deal was very clean.
Yeah.
I don't think you could have had an easier one, which is good. That's no complaints on my side for that. But it is huge, and you showed me things to consider, and the guidance that you gave and continue and
thank you
that you give clients is huge. So it's unfortunate that client had that. Hopefully the deal got done and they made it happen.
Yeah. So we actually to finish that story, they went with this agent on the purchase, right? They had to close on that house because they had a commitment. I put a deposit, etc.
Yeah.
They thought they had time for due diligence. Surprised they didn't have any.
Yeah.
So I had to close on that house, and we helped them on the sale of their house. So we pushed really hard to sell the home as fast as possible. And
which I'm sure you did well, but unfortunately that sometimes puts pressure on the price. You have to be willing to accept something that's less. So even though you might have been able to get X, we have to take some off of that because you
nailed it.
You need to get rid of it more than you need to have a bidding war, drive up price, whatever it is. Yeah.
That's it. Yeah. So it was challenging for sure. I mean, but luckily we were able to get a firm sale, and it's closing before the end of the year, right? So they're extremely happy. Best Christmas gift ever, right?
With that bridge loan, they might not be.
Yeah, that's it. Yeah,
a little pricey.
That's it. So it's closing right before, so that's good.
Good.
So yeah, no, that's a great story. It's good that we, because I had thought of that earlier. Talking about that particular story, but last thing I wanted to chat about, because we have you here, obviously, you know,
Yeah.
I don't know how much information you have about this deal, but it kind of took everyone by surprise. It's like RBC buying HSBC, right?
Yeah.
You know, and there's a lot of questions that come up, you know, like as I was chatting with Jen and also with you on the phone the other day, like that shows some confidence from RBC in, you know, in the current, because most of HSBC's assets are mortgages, right? So
Yeah.
that shows some sort of confidence, I would say, right? In the mortgage.
Yeah, I think it shows a confidence in the underwriting of HSBC's loans.
Okay.
I think it shows strength in that the deals that they're acquiring, the assets, and subsequently the lending that RBC is acquiring from HSBC is they believe in the strength of those loans, and they don't think there's going to be the risk of default on those loans is something that RBC can accept and acknowledges is low enough that they want to take on those loans. And again, that kind of going back to having quality professionals, that comes back to the underwriting of those deals and being able to tell a story about a corporate, you know, a company that's taking on a loan, an individual who's getting a mortgage, whatever kind of lending you're doing. And so I think it shows RBC has comfort in the assets it's buying. And I told you this over the phone as well, is that it's shifted from, and I'm not saying RBC on this side, I think a lot of times people try and buy things at a discount, stocks, homes, cars, whatever it may be. And sometimes, like you say, you got to take the time to do your due diligence to make sure and find out why that item is being sold at a discount. Because is it being sold at a discount because there's more supply than demand and people are trying to get rid of it, but it's a quality item? Or is it being sold at a discount because there's rust under the car, there's a faulty foundation, the financials of a company are weak and you can't see that? So it's important to find out why. And so we think the acquisition of, I think the acquisition of RBC getting HSBC was them paying a premium for a quality product as opposed to buying something at a discount.
That makes sense.
And HSBC is a well-known institution. It's a great institution. And we think the acquisition is sound. But with regards to where the risk of default is going, default rates are actually quite low across the board. And I think that's the fine line, kind of shifting gears here a little bit, that the Bank of Canada is doing with regards to interest rates, is it's that fine line of curbing inflation while ensuring that Canadians aren't put into a financial kind of, you know, stranglehold.
No.
And so it's tough because, again, the inflation, obviously, you know, things going up 7%, you know, what costs $1 now costs $1.07. Not a big deal. What costs $10,000 now costs $10,700. That's more of a big deal. 100,000, 100,000, 107,000.
Yeah.
You know, when the numbers go up, it gets bigger and bigger. And so to curb the inflation, they have to increase the rate, which creates the spending, kind of not an economic slowdown, but it makes borrowing tougher. So now that that's happened, you know, the rates, like you say, kind of going back to the default, there's a concern of the default of these loans. And so it's a fine line between how high can we push the rate to slow inflation without causing defaults of loans and truly impacting the lives of people. And I think we're at the point now where we've kind of found that sweet spot, that we kind of reached that max. And again, like we were kind of touching on earlier, where we think the rates might not go up too much more. They can, but we think it's going to start a slow trajectory in 2023 to decline slowly. And again, that's going to be impacted by a lot of the underlying numbers that come out quarter by quarter. But it's a long-winded way of saying we like HSBC's acquisition. No, with regards to the rates, it something's got to give. And like you say, the tightening of finances by having these increasing rates of loans and the risk of default is a true thing. And obviously we saw what happened in 2008 when that was the housing crisis and the defaults of the loans kind of collapsed everything. And I think we learned from that, and that's why you're seeing more awareness of where the rates are going. Mm-hmm. And there needs to kind of be an acknowledgement that what the rate increases did and what they've done. And again, as the kind of saw with the numbers there, the defaults are low, but it's definitely increasing in risk. And so if the rates kind of decrease a bit, that kind of just relieves some of that pressure.
That's good.
So
that's awesome.
It's going to be interesting. We'll see. At least interesting to me. I don't know.
Yeah, I mean, I know this is all forecast, and it's hard to pinpoint. If you have a crystal ball, I mean.
And I would say as well, it's you're not going to see rates go down as fast as they went up. That's going to be, you might see 50 basis points or something like that in the first couple, but you're likely not going to see 100 basis points or a 75 basis point decrease overnight. So, if you're waiting, again, I'm not giving guidance here, but if you're expecting to see rates go from 5% down to 3% in June 2023, impossible, no. Unlikely, yes. But there might be a small decline, but you factor that in, but don't make that your end-all be-all decision
that makes sense.
on anything you do, but it's definitely a factor.
That's good that you bring that up, because we have this conversation all the time, right?
You probably hear all the time, where do you think rates are going to go?
All the time, and also, with when we're calling someone that's, that was contemplating buying something, they're like, oh, I'm just waiting for rates to come down. And the reality is that, like, we don't think, I agree. I mean, obviously you know more, but I agree. I don't think they're going to come down that quick. I mean, it's going to take at least a few years for us to start seeing any sort of decrease, a year or two, anything significant at least.
Yeah. And just because the government lowers the rate doesn't mean the lenders are going to do so. The increase in interest rate is reflection of the risk that they think they're taking on. The less risk you are, the lower your rate's going to be. It's why a credit card is 20%.
That's it.
So obviously a mortgage is going to be one of the lowest you get. It's a secured asset. You don't pay your mortgage, they get your house. You don't pay your credit card, well, they don't take your purchases.
Yeah.
So it's reflective of the risk, again, that the lender is willing to take on. But yeah, it's hopefully it gets back to a normal rate. And again, normal rate's going to be in the 3% range.
Yeah. That's the very first house I bought. It was in it was in 2005, but that was with my parents who helped us out, and then refinanced that. And in 2013, very first house, and it was 3.45%.
Yeah.
Right, and that was considered decent. Like,
yeah,
that was considered a good rate. Like,
and again, when you're looking at hundreds of thousands of dollars, your first time you're looking at a rate like that, it seems expensive. I was joking with a colleague in the office, and he showed me a picture of some article or a magazine in the 80s, and it was Bank of Canada cuts overnight rate to 20.25%. It's like, imagine having a mortgage at 20%. That was a cut. Yeah. So I didn't see what it was before, but yeah, it's definitely tougher times right now. And not to say that, they had it harder or worse. It was just different. You can only borrow so much at those rates. So obviously,
it stopped. This one here stopped. I think we're out of.
We might be out of space. Yeah. He's talking so much today.
That's amazing. Oh, there you go.
Quick swap.
There it is.
Oh, that's awesome.
The camera's dying too, so.
No problem.
I want to shift it a bit that way.
That's going to come a point where I just go up.
There you go.
Yeah,
so.
Sit from my phone.
Good.
That's awesome.
So kind of continuing that though, it's you've seen that. So kind of when the rates go up, the price goes down. You can only borrow. When the rates go up, you can borrow less. Yeah. So you're probably seeing that a lot as well. What used to be a seller's market is now
more balanced.
Maybe shifting towards a buyer's market.
Yeah. Not quite fully, but yes.
Yeah.
Way more balanced, yeah.
Ottawa is an interesting market too, and this is now your expertise. And correct me if I'm wrong, but there seems to be these moments every so often where the market just pops.
Yes, it was affected, but not completely. Like, there were still condo sales were booming back in 2008.
Yeah.
2008, 2009, right? Going back to Jen's story when she was talking about earlier, in earlier podcasts, she was talking about her first, condo, like second condo purchase here. It was a tower going down in 200 Rideau, and that was 2008, right?
Yeah.
And it was sold out.
Yeah.
Right. So I think going on that end, like, Ottawa is fairly resilient.
Yeah.
We're a little bit insulated, I think, with the amount of government.
Yeah, a lot of government, but at all levels, federal, provincial, local, and professionals. So it's a pretty defensive city when it comes to the market, but it doesn't change the fact that borrowing right now is
it's tough.
A little pricier, a little more expensive. So,
cool. Well, we'll definitely have you here again, Brent. Thank you so much, Brent Daviault with Wealth Management at RBC. Thank you so much for being here, and thank you everyone for tuning in.
Yeah, good to see you, Leo. Good chatting.
Thank you.